It wasn't a market correction. It wasn't a policy error. It wasn't even a geopolitical accident. It was the mathematical inevitability of a sovereign debt cycle entering its terminal phase. The pattern is unmistakable. It appears in every major empire that has ever held the reserve currency of its time. The arithmetic is merciless. When a ruling power accumulates debt it cannot repay through productivity, it chooses the only politically viable option. It devalues the currency. It prints the difference. It quietly transfers purchasing power from the prudent saver to the indebted state. This is not a conspiracy. It is a structural mechanism. History provides us with 3 specific case studies that act as a mirror to our present moment. Consider the Roman Empire in the 1st century. Under the Emperor Nero, around 64 AD, the state faced a fiscal crisis. The cost of the army, the bureaucracy, and the public games exceeded tax revenue. Raising taxes was politically dangerous. Cutting spending was impossible. So Nero chose the third path. He ordered the mint to reduce the silver purity of the denarius. He clipped the edges. He mixed in base metals. He increased the money supply to pay his debts with inferior coin. The result was the first major inflation in Roman history. Think about what that means for the average citizen. The Roman soldier, paid in denarius, suddenly found his salary purchased less wheat, less wine, less land. The wealth was transferred from the soldier to the emperor, who spent the new money first before prices rose. By the 3rd century, under emperors like Septimius Severus, the currency had collapsed entirely, wiping out the merchant class. Just like Rome, the Spanish Empire in the 16th century fell into the same trap. Under Philip II, Spain was the dominant superpower. It controlled the seas. It controlled the Americas. But the crown was addicted to war and monument building. Despite the massive influx of silver from the New World, the state spent more than it earned. By 1557, the crown declared bankruptcy. To keep the machine running, they turned to the vellon. This was a copper currency, minted without intrinsic value, forced upon the population by royal decree. The price revolution followed. The cost of goods in Spain soared. The Castilian peasants saw the price of bread triple in a lifetime, while wages remained stagnant. The aristocracy, who owned the land, saw their nominal wealth explode. The middle class was hollowed out. Their savings evaporated by the flood of cheap copper. The empire began its long, slow slide into irrelevance. Just like Spain, the Weimar Republic in the early 20th century accelerated this timeline. The year is 1923. Germany is crushed by war reparations and a paralyzed industrial base. The government, unable to tax a starving population, turned the printing presses on. The Reichsbank, led by Rudolf Havenstein, believed that printing money was necessary to provide liquidity. The result is well documented. But the mechanism of wealth transfer is often misunderstood. It wasn't just that bread cost billions of marks. It was that debt was wiped out. Industrialists who had borrowed heavily to buy factories suddenly found their debts erased by inflation. They ended up owning the real assets free and clear. Meanwhile, the university professor, the civil servant, and the pensioner, people who kept their wealth in government bonds or cash savings, were destitute within months. A lifetime of labor was transferred to the owners of real assets and the holders of debt. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money. The currency is backed by a hard asset or strict discipline, and the economy grows through productivity and trade. Stage 2 is the burden. The society becomes successful, complacent, and expensive. The state takes on obligations, welfare, warfare, or bureaucracy that exceeds its tax receipts. Stage 3 is the shortcut. Politicians, refusing to cut spending or raise taxes, begin to deficit spend. They issue debt to cover the gap. Stage 4 is monetization. The debt becomes too large for the private market to absorb at low interest rates. The central bank intervenes, buying the government's debt with newly created currency. This suppresses interest rates and enables further spending. Stage 5 is asset inflation. The newly created currency does not flow evenly. It flows first to financial institutions and the government. It bids up the price of stocks, bonds, and real estate. The wealthy feel richer. The middle class sees housing prices drift out of reach. Stage 6 is consumer inflation. The money eventually leaks from the financial sector into the real economy. Prices for food, energy, and services begin to rise. The authorities will initially call this transitory or blame supply chains. Stage 7 is the fracture. The population realizes the currency is losing value permanently. They flee into hard assets. Trust in the sovereign debt evaporates. The system must either reset or collapse, just like Weimar. The United States today exhibits the classic signals of Stage 5, transitioning rapidly into Stage 6. Current data suggests we are witnessing a textbook application of this cycle. The national debt has moved parabolic. The central bank's balance sheet has expanded by trillions in a historically short window. We see the classic divergence: asset prices, homes, equities. Collectibles have soared, enriching those who hold them, while the purchasing power of wages has struggled to keep pace with the true cost of living. Some economic historians argue that this comparison is flawed, because the US dollar is the global reserve currency. They contend that global demand for dollars is infinite, allowing the US to export its inflation to the rest of the world. This has been true for decades. However, the incentive structure has changed, as the US weaponizes the dollar through sanctions and debases it through issuance. Rival nations are actively building alternative settlement rails. The exorbitant privilege of the dollar is not a law of physics, it is a matter of trust. When that trust erodes, the vast pool of dollars held overseas begins to return home, exacerbating the domestic inflation. History shows us there are only 3 endgames for a cycle of this magnitude. The first endgame is controlled decline, often called financial repression. This occurred in the United Kingdom and the United States after World War II. The government keeps interest rates artificially below the rate of inflation. This allows the state to burn away the real value of its debt over a decade or two. It is a slow, grinding tax on savers. The middle class does not lose everything overnight, but their standard of living slowly degrades as their savings fail to keep up with the cost of life. The second endgame is chaotic collapse. This is the path of the Soviet Union in 1991 or Zimbabwe in the 2000s. The state loses control of the bond market entirely. Hyperinflation destroys the currency. Commerce halts. The economy reverts to barter until a new currency can be established. This is the outcome when the government refuses to stop printing until the very bitter end. The third endgame is reset and restructure. This happened in Germany in 1948 with the introduction of the Deutschmark. The old currency is scrapped. Savings are converted at a fraction of their value. Debts are reorganized. It is a painful, sudden shock that clears the system, but wipes out the paper wealth of the majority. The only variable is timing and pain. Subscribe to this channel. Educate yourself on the history of money. Build resilience in your skills, your community, and your understanding of these cycles. The transfer has already begun.